Hello, everybody. Welcome to yet another session of Beyond Words and Years by Team of StaG. I, Mridul Jalan, the CIO of StaG AIF, use this opportunity to interact, share my view with the audience about what has happened in the market this week. This week was relatively a quiet, lackluster week with the result season being over and the market resting after the kind of carnage we saw before that. There was not much movement in terms of Nifty. Nifty was down less than a percentage. Mid cap index was up just a bit, slightly up, even less than 1%. We saw selling in the defensives, IT and pharma, and some buying in quality mid and large cap. Broadly, it seems that the market continues to digest the new texture, which is that Indian markets continue to underperform. The global market seems fine, though US seems to be talking about stagnation post Trump coming in, and as his policies of higher tariffs get digested by the economists, there's a belief that US might go through a process of lower growth and higher inflation. As a result, the rate cut expectations by Fed has also been decreasing. Coming back to India, the earnings for this quarter was fairly, I will say, better than Q2, but overall muted. The reason for the mutedness in the earnings was more to do with the fact that the margins were lower while the revenue growth seems to improve. Last 3 months, if not last 6 months, last 3 months in particular, have made a lot of people realize that equity is not an easy game. Uh, your investments in equity tend to be volatile. In fact, among all the asset classes in the portfolio of any investor, equity and equity related products are the only ones where there is a probability of a negative return. Uh, and it's the only asset class where you look at the value or the returns on a daily or a monthly basis. Whereas be it debt, you don't get negative returns in most times. Real estate, you don't even check your prices for years. Uh, in terms of other products like gold, you don't even consider it as an investment, hence, and you say that it's for the future, so you don't worry about the prices. Equity is the only asset class where we humans tend to look at the prices on a regular basis and tend to make reactions and decisions based on that. Well, it's good to review your investments, but the tenure of the investment needs to be aligned. The problem is we at StaG believe that the tenure of equity investment has to be as high as any other investment of yours. Whereas your expectations of the return should also be high, but not in the short term. The fact of the reality is that for equities, and especially those because of the way the markets were between 2020 to 23, that people wanted a quick money in equity, which happens in quite a few moments, but doesn't always happen. Last week, I shared the data. We came out with a detailed report around it. And as the data shows, that in the long run, and by long run, I mean at least 3 years, you will always make smart money in equity if your investments are right. But if you will go just by the myopic figure, then you may not be the best situation. The counter argument to it is that why can't we enter at a better price? Surely you can, but do we know what is the best price? Because when the market are up, either we do a FOMO or we end up saying that let's wait for a correction. But when the correction comes, you don't know when is the bottom. And hence we say nahi or correct hoga. Or we will see more downside. Then let's wait for it. So if you are on the fence, you end up remaining in the fence or becoming a victim of a FOMO. So the best way, which many smart guys have said, and we have read it in across various books also, is the best way to invest in equities is keep participating your extra cash flow, the long-term wealth creation process by keep investing in equities at every level. The only thing what matters in equities or related to equity returns is the fundamental earning growth. If the fundamental earning growth is there, then the multiples will follow suit. There's a there's a common saying that ये पल भी बीत जाएगा, which means that this time will also change. So when the markets are going up, 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 we think that the markets will not fall. When markets are falling, we think the markets will not go up. It doesn't happen that. We as long-term investors needs to be prepared for both the scenarios. And the way we can do it is putting the right money with the right tenure into the equity investment so that it grows at its own pace. Managing our investments and expectations is in our hand. Managing, predicting the earnings is in the hand of a good asset manager. But trust me, predicting the liquidity is not in the hand of anybody. It's a group effort, and it is the liquidity which drives the range of the market along with the earnings. Over my 25 years of experience, what I have seen is that when the earning growth is above the 10% mark, which is closer to 13 to 15% mark, your market trades, when I say market, I mean Nifty, trades in the range of around 20 to 28x. If you think that over the next 3 to 5 years your earnings growth is going to be around 10% or lower, then the same range becomes 14 to 25x, which has been our range pre Lehman Brothers time. Post 2014, with all the corrections in the processes, in the economy and everything, we started growing from 2016-17 to close to 13 to 15%, and that has been the CAGR of index even after this correction. And any fund which is well placed with the earnings had given a better CAGR. Add earnings pick, add beta to it, and your range of returns will look better. If you go back and if you look at it, whenever the market has done a steep correction, it has done because either it's a liquidity issue or an earnings issue. Currently, market I think is crippled with the fact that there is a little confidence on earnings, and which is why we have come to a point of a steep correction in the market. Nifty is down roughly 14% from the top. My technical team tells me that in a bull market, the Nifty doesn't crack by more than 20% on the peak, which means the downside at max is 5%. And if the earnings do follow in April as we believe it will, then there is little downside while the upside is higher. So what's important is while you need to decide your equity investment is not what market will do in 3 months, but it is important to understand what the earnings will do in 3 years. If you believe the earnings will be good in next 3 years in the range of 15 to 17% growth, which Senora believes in, then trust me, there is a lot of money to be made in the market because investors don't look at 3 months. If you want to, what will happen if let's say at worst market falls by even 10% in the next 3 months? Your returns will only get better by a couple of percentage points on a CAGR basis. But if you miss it and you either don't invest or end up investing at 10% higher, then the risk reward is not in your favor. Hence, the psychology or the philosophy which we at Stag have is only one thing. When you have a right tenure of money, when the risk reward is right in your favor, please keep investing money into the markets. In fact, our experience as advisors, where we started that business in back in 2018 and managing money right from May 2019 for our clients as an advisors, The CAGR between those who did one-time investment and to those who did a SIP, the CAGR of those who did SIP are still higher by a 3 percentage point more than those who did one time. Ultimately, investing at every level of the market helps you to get a better return because you end up getting more exposure within the reasonable period of time, and you do not take FOMO based decisions of either being over invested or less invested over a period of time. Large caps are now trading at sub 22 times. If you believe that the earning growth is going to be north of 10%, closer to 15%, if not more, then the downside is limited. But if you believe the next 2 3 years the earning growth is going to be still be lower and closer to 10%, then with a lot of talk around a further correction, I will say that yes, we may get into a stagnation or a correction. We at Sonora believe that there is very little probability of earning being less than 15% for quality large cap as a basket, and hence your returns will have to be closer to 20-25% from here on. The risk reward is amazingly good. I don't want to talk much beyond this. The psychology and the thesis remains the same. Identify quality, earnings driven companies which will continue to grow faster than the peers, will continue to reward the minorities, will continue to use the capital well, and use leverage for growth rather than running the company are some of the pointers which we look at while picking our portfolio stocks. Uh, that having said that, it's more about psychology because you tend to see the prices on a daily basis. You have access to the prices on daily basis because there is so much news media around equities, while there is not much coverage about debt, real estate, or any other asset class. And hence, human as a psyche, we end up thinking and talking more about it. Where have the large investors make money? Be it Warren Buffett, be it Rakesh Jhunjhunwala, be it anybody. They have made money when they have identified something and played it for a long period of time. They never worried about 1 or 2 quarters of liquidity or results into it. So if you believe in the India story, if you believe everything is in the right track, don't worry about couple of months. That is only going to hinder your decision making, will hinder you mentally, and may impact the BP of somebody who is slightly light-hearted. The important point remains is equity is a tough asset class because you need to avoid the noise. You need to be disciplined to know what kind of an exposure is needed in equity by not putting all of the rupee in equity or by not putting 0 rupees into the equity. Having the right mix is the first steps towards this, my friend. And that is something we always advocate to our clients, to our channel partners, that having the right psyche is the first step of investing in equity. And that's the biggest mantra of being successful wealth creator through equity. Identifying the stocks, identifying the macro, and everything is the job of the fund manager, the equity fund, the guy who is identifying the stocks for you. You need to just invest in the right amount of money in the right strategy and let the rest happen by itself. That's my limited point today. Happy to take questions. As usual, I will wait for a minute to see if there are any messages on the chat or on my WhatsApp. With no questions, thank you for your time. Thank you for listening it out. It's a pleasure always to speak to you guys. For those who know me, I'm always around my email or WhatsApp for your queries. Thank you. Have a good weekend and hope we have a good India Pakistan match today for all the cricket fans. Thank you.